Okay, today is Monday, April the 7th, 2014, and in front of me I have the SPY daily chart that I brought up in profit charts. As you can see, it's been quite a year, 2013 and going into 2014. We have tested the 100-day moving average 4 times. And we see quite a bit of volatility within the market and the SPY specifically, and also SPX, of course. And when this typically happens, usually this is an indication that either one of two things: either the market is working out the pressure that it has to the downside by having these volatility swings over time, slight volatility swings, or that this is in preparation of a move to the downside. So at any rate, we can continue to expect that volatility in the future, if the past trend continues, volatility in the future should also be cycling up again and perhaps swinging around down and going back up. So how can we take advantage of this? So one of the ways to do this is with VIX options. There's two basic approaches with VIX options. Obviously, if we think volatility is going to be going up in the S&P 500, then we can buy VIX call options. And typical strike price to look for is around 20, since that was the historical average of the VIX for a very long time. The mean was around 20. I don't know quite what it is right now. I think it's still close to 20, even though these last few years have probably brought it down somewhat. So here we have the May. This is May 4, means it's through May 31st expiration. Strike price at 20, and it's a call, obviously, for 75 cents. And it's a single call option, as is listed here. And if we take a look, the theta is almost around $2 a day. The theta is your time decay. That's what you're going to pay to hold this contract on a daily basis. Let's take a look under Analyze. We can see that at 18, if the VIX was 18, then we could expect to make a profit of, well, it obviously depends when it hits the 18 level. So if it hits it April 8th, we'd be making approximately, not exactly, but somewhere close to $81.16. If it hit it at May 6th, we'd actually be losing about $9.50 almost. Of course, these are approximated numbers. The actual market will dictate, obviously, what you make or lose. Now, if we only expect volatility to go up a little bit, then really this isn't the best contract for us to buy. We really want to do a spread. Vertical spread, where we buy the May 4, 2014 20 call, and we sell the 25 call. And we're not going to make as much, but as we go out in time, we're not going to lose anything because we've sold a contract. So our theta decay, as you can see, is like a little bit less than 50 cents. So that being said, we won't make as much, but then again, we didn't pay as much either, so we could easily double up our position or triple up our position if we wanted to. So we're basically paying almost half. We're paying 40 cents instead of 75 cents per spread or per contract. The VIX at 20, we do fairly better, obviously, because if the VIX gets up that high, the spread's going to be worth quite a bit more. So in this environment where we expect volatility to go up, but we're not expecting volatility to go up to 40 or 50. If that was the case, and certainly the single contract, the call 20, would definitely be the way to go. But for small volatility spikes, definitely we want to look for a spread. Okay, that's all for now. Thanks.